$5 مليون يعطينا 5 مليون دولار بس
Good morning, good afternoon, good evening, everyone. This is Joseph Trevisani from Worldwide Markets. Thank you for attending the webinar put on from WWM, Worldwide Markets, and FX Street. Today I take as my topic an old adage, axiom, cliche, if you will, from the economists, from analysts, and I start out with that. Never, and somebody told me this a number of years ago, and I've always taken it to heart, being its purpose. So by the way, if anyone has any comments, criticisms, anything you'd like to add, especially on the Forex video channel, FX Street Forex Live video. Please type it in. I have it monitoring here, and I'll look at it, and I'll be glad to talk about whatever it is that you have, whatever you're interested in. And I like participation, of course, so please participate. The old adage is for analysts and forecasters from the markets. Whenever you're providing analysis, give a rate or a date, but never both. Meaning, you can say, well, the euro's going back up. When? I'm not really sure. Or the euro will be at 120 in the future. When? Oh, I'm not really sure. So you never provide both because you're almost always going to be wrong. It's impossible to predict with that kind of certitude, frequency, or success. After all, the basic idea is that if I could sit here and predict where the euro would be on April 4th, I would be betting that in the markets, and I would have retired and bought an island or three a long time ago. So it is not possible. And in order to both maintain your credibility, but also to maintain your ability to analyze, you must maintain your humility. One thing the markets teach in abundance, and politics, as we're learning as well, is humility. Certitude has no place in trading. Odds are what we're talking about. So the one time when I do provide something along the lines of a prediction is right here at the end of the year. And so that's what we're going to talk about today. What are the macro trends, in, both in economics and in currencies, that we're going to be looking at in 2017? The easiest thing to do in this kind of analysis is to simply take a contrarian position. Say, well, the euro's been coming down, the euro's going to go back up. For currencies, this is a fairly logical step, fairly logical way to approach it. I'm going to do that, but I'm also going to do it based with rationales and reasons behind it. The primary technical aspect of markets is quite simple. It is reversion to the mean. For most tradable assets that are actively traded, currencies, commodities, stocks to a great degree, although stocks less so, the main driver, both on the inception and on the ending of the position, of course, is taking profits. Looking for profits and taking profits, which is what powers the whole idea of reversion to the mean. If the euro comes down 20% and everybody's short, the only way to get profits booked and get your bonus, if you're trading professionally, is to go the other way. So that's where reversion for the mean really becomes probably the most powerful idea behind a trading market. Okay, but again, if you look at WTI, I think I have WTI here. Let's take a look. Yes, we have WTI, the American Crude Standard. Going back 4 years, it's going to be pretty difficult to look for the reversion to mean in this particular chart. The reversion, the mean is somewhere around $70 here or so between this area and this area here. There's certainly no indication of what we've seen so far that we're reverting to the mean. So it's not always it doesn't always work, but for things, and there's a reason for this, for things such as equities, the overall equity average, and WTI, there's a very powerful real world factor here that plays in. Unless the economies start to shrink, equity averages go up simply because the economy is bigger. There's a bias to the upside in equities, which we all know. WTI and other commodities are determined by supply and demand. Well, if you have a permanent change, the if you have a permanent change in either side, you don't get quite the same propensity to revert to the mean. And we have had a profound change in WTI and in oil in general, which I'll talk about in a minute. But anyway, let's start with currencies, since that's what we do. And I will make some, oh, there's one other thing I want to bring out. Okay, let's start with currency. We'll start with the Europeans first. Not really the Europeans, but the majors, as they're called. Major leagues, major trading, greatest volume, the majors. So here we have the euro in white, the sterling in green, the DXY, not trade weighted, just DXY, in orange, and the yen in the purple. And if we look at 2015 and 2016, but certainly 2016 and the latter part of 2016, there's a pronounced trend here. We're talking here, here. Even the sterling has it a little bit, and the euro going down. And of course, that's dollar strength. For most of 2015 and 2016, if you look at the trading range, you didn't see a lot of change in the euro. Most of 15, most of 16. In the DXY, most of 15, most of 16. Sterling, singular circumstances, of course. The vote to exit from the EU. And the yen for most of 16, also singular circumstances. What are the singular circumstances? Well, they're right here. The singular circumstances for the yen is this. That's the Chinese yuan. You know, it's amazing. The way the markets change their focus. In last year, in the summer, and then certainly at the beginning of 2016, there was enormous consternation about the Chinese yuan and what the levels of the Chinese yuan signify. Well, we are far above the levels at that time that signified enormous concern, supposedly, for the Chinese market, and nobody's paying the Chinese economy, and nobody's paying any attention. But so this depreciation in the yuan is the flip side in many ways, not exclusively, but in many ways, the ascent of the yen. Here we go, back to the yen chart, back to the general currency chart. From this period here, the yen is purple. So as the yuan goes down, the yen goes up. You can look at this in various ways. It's difficult to trace, but they are coincident in time. And since the economies are a lot of China and Japan are far more than simply coincidentally placed next to each other, they are most seriously intertwined. There's a great deal of investment, Japanese money in China, and on and on and on. So those are the trends that we saw for most of the year. Non-decisive in the dollar, specific to the sterling for the cable, and specific to Asia, if you will, and China for the yen. And what have we seen since the American election? We have seen a profound shift. And I would put to you that it's not simply the American election. But the dates are very convenient to use. We've seen a profound shift in the fortunes of the dollar, the prospective fortunes of the United States economy, and the reflective responses in the currencies. The euro's gotten hammered. The sterling has a bit of a bid. We'll talk about that in a minute. Although not so much, it's come off again. The DXY has had a bid and the dollar yen has had a rocket. So what is going on here? I think two things are going on, which have propelled the dollar to its heights. at the moment. And I think the euro is back to 13-year highs. I mean, the euro's only been around, 17 years, not even 2 decades yet. I mean, you've heard this from me before. I was sitting on that trading desk in Hamilton, Bermuda, at the Bank of Bermuda, the night, I think it was January 2nd or January 3rd, 1999, when all of us were a little bit younger, when the euro started trading, and it went remarkably smoothly. I simply started trading the euro yen instead of the mark yen, instead of the Swiss franc yen, or the other crosses all disappeared. Nobody was quoting them anymore, and everything was funneled into the euro. It was fascinating to watch it. It wasn't any real shift in the way you do business. You calculate the euro yen the same way you calculated the mark yen. Numbers were a little different. They got a little bit used to because you're acting very quickly. But it was a very simple, well-prepared, well-thought-out transition. The history of the euro until the financial crisis was generally positive. And since the financial crisis, it has become increasingly negative. Much of that is reflected in the euro rates we've been trading. But before we look at the issues from the United States and reflect on the election, and it is very interesting the way the markets have responded to the election of Donald Trump. And if any of you were observing this, do not believe anything you're reading in the media about electoral college and switching votes and anything like that. That is political manipulation, probably a desire by the losing party to sort of take some credibility and some legitimacy from the election. January 20th, on this Monday, actually, the electors vote. They will vote to elect Donald Trump. And on the 20th of January, he will be sworn in as President of the United States. So focus on that and not some of the attendant silliness that's coursing through the media right now. So we have 2 factors here that have come together. The first has been, 3 factors. And I think the first factor that I'm going to talk about is, I think, going to be the story for 2017, especially the second half of the year. Can you guess what that is? I'm not going to offer any I'm not going to offer any prizes because I don't have any. If I did, I would. I think the most, and it's really not been spoken about, I'm probably going to write upon this next week. It is the recognition that zero rate policies, I would call them a failure. Other people would not, of course. They would call them a success because they prevented the end of the world. Well, the world may or may not, was or was not scheduled to end in the fall of 2008 and in the beginning of 2009. My guess, it was not scheduled to end. However, it's difficult to, and I'm not attempting to argue with 2009, 2010, and probably into 2011, that zero rate policies did not have their purpose. And besides, more than anything else, you can make a case that the confidence that was supplied, that somebody was minding the store from the policies of Ben Bernanke and the US Fed, leading the way, of course, were necessary to prevent panic. And I think that's probably true. But after that point, it becomes extremely problematic whether the zero rate policies do more harm than good. As the stock market, as a reflection of, let's say, economic confidence, was rising through 2012, 13, 14, 15, 16, one of the constant themes of commentation, I think there's a word commentation, it's not commendation, commentation, was when the Fed starts raising rates, will the markets tank? Are they supported purely by excess liquidity flowing into markets to chase profits because of the inability to get profits in almost any other way? Very slow growth, certainly nothing from the credit markets. So where do you go? And that argument was made, and I made it myself, over and over again, that given that time period, that market psychology, remember throughout most of the, well, all of the 8 years of the Obama administration, US economic growth has been around 2%. Wage growth has been around 2%. These are very historically anomalous figures for the years on recovery following a very serious recession. But there was certainly very little sense of acceleration of movement. The Fed kept looking for it. It never appeared. Under those circumstances, the argument that equities and the economy in general could not stand or tolerate a series of rate increases back to more normal levels was certainly one that was accepted by the Fed and many, many other people as well. And in fact, the Fed never raised rates. And when we look at the response we saw at the beginning of this year to the Fed raising rates once in December 2015, you had to give a good deal of credit to that particular argument. Now you can say, of course, that the Chinese were compounding it or by devaluing their currency, possibly, and certainly the two played together. But that very serious equity swoon back in January and February, I think it was 13% or something on some of the indexes, scared the Fed out of its collective boardroom. It took them a year to get around to raising rates again, just now, last 2 days ago. So in that psychological environment for the markets and in the economic macro picture of that time, the argument that the Fed could not raise rates because the economy was too fragile seemed quite valid. There has been a rather astonishing change. The US economy has continued to create jobs since that time, moderate level, not a bad level. Wages have not gone anywhere. So, many of the complexion of the created jobs is very, very much less as far as its economic benefits and its ability to power the economy than in previous recoveries. There are a huge number of part-time jobs. The Fed, the Labor Department, as part of their statistics, counts part-time jobs as created. I don't buy this one. I think the jobs should be what you should factor in what you should do is you should follow the number of full-time jobs. So if you get two part-time jobs, that's not two jobs created, that's one, or depending on how many hours a week work, one full-time job. I think you'd get a much more accurate picture, even if it's not going to replace the U3 rate, it would be a much more accurate picture of the labor economy's ability to drive the market. Because after all, what drives the market is the ability to spend, what drives the economy is the ability to spend money. And if you have 3 or 4 part-time jobs, and each one of them works 10 hours a week, you basically have one full-time job. The amount of money flowing out into the economy would only be marginally higher because the 4 part-time jobs will still have to spend on essentials, which would not be duplicated if they were. The amount of spending on essentials would not be the same as if it was just one person, because after all, you only have to eat so much, and 4 people have to eat more. So they have to spend a greater portion of that amount of income, nonetheless. So for much of the period that we're talking about, the economy was not prospering. And so the Fed could not raise rates. And that was certainly one of the reasons behind it. The subsequent development of the U.S. economy, I mean, we have 3.2% in the third quarter. It probably looks like we're going to have somewhere around 2.5% in the fourth quarter. That gives the economy for 2016 yet another year of 2% growth. There's nothing in that statistic. There's nothing in the non-farm payrolls and the wage numbers that tells you that there's nothing there that justifies, from an economic and a macro point of view, a Fed rate increase. There's a little bit higher inflation, but for inflation to be concerned, there's got to be wage participation, and there's clearly not. So the Fed's stated desire to raise rates is not a reflection of a profound change in economic statistics or in the performance of the U.S. economy. There's an interesting supposition here. Let's try this. The markets have clearly responded gleefully to the election of Donald Trump. This is not a comment on Mr. Trump, on his policies, on his appointments, or his hairdo. This is simply a statement of fact. The equity markets and the credit markets have responded forcefully in a manner which means they expect economic growth. They expect profits. They expect higher rates. All of those things go together. So they have responded in that fashion, simply a statement of fact. So the Fed's prior concern that a program of normalizing rates, of getting rates back to wherever we think the normal rate of return is now, I don't really know. I don't think anybody knows. It's probably not what it was. If you take a historical average, it's probably lower than that, since that's skewed very heavily, higher from the 80s, from the Volcker era and subsequent years. So whatever it is, we don't know, but it's higher than it is now. The Fed said, they raised their famous dot plot. There used to be an old comic strip, I think, from the 50s and the 60s called Dot. I don't know if anybody remembers it. Here in the United States, I don't know if it's around the world. It's an actual comic book, not the graphic novels. I see my girls reading graphic novels all the time. You have to monitor what they're reading, of course. They're only 8. Anyway, so Dot liked dots. She only wore dots in her clothing, her blankets, her towels, her car, or her parents' car, her children's scooter, her doll carriage, everything was dots. Don't know what happened in that comic, but anyway, okay. So the Fed's famous dot plot. Beginning of 2016, they were going to raise rates 4 times. They didn't, for obvious reasons we all know. Brexit, the equity collapse, the March and April, I think it was March and April and May, severe drop-off in non-farm payrolls, a number of things in the real world, which all seem to have disappeared, prevented the Fed from raising rates, or at least blocked the Fed from raising rates. But certainly one of the things that was involved in that equity swoon was the idea that the Fed is going to raise rates 4 times, which is a pretty rapid pace, especially considering the state of the economy in 2016. Well, this last meeting 2 days ago, the dot plot, dot plot, I have to work that in somehow. I'm sure I can find a picture of Dot, this comic. Sorry, I'm getting focused on this on the web, and use that to illustrate one of my columns. Anyway, so they're going to raise rates 3 times. That's up from 2 in September, which was the last time they released the dot plot, and the markets are having 0 effect whatsoever. So we have this it's only a year, and the economy is not really performing any better than it was, marginally so, If we assume that the 3.2 and the 2.5, which gets you close to a 3-point growth rate, which is better than anything we've had since the recession, if you assume that's going to be accurate going forward, then you have a vision of a better economy. And I think this is part of what's going on, because with the election of Donald Trump, the markets are assuming that his administration is going to be business friendly. So you're going to get more things, and we will find out whether many of the criticisms of some of the Obama administration macro policies will be borne out. It is possible that the relatively anti-business tone, that the heavy emphasis on regulations and the complications from the healthcare plan did detract from economic growth, and some of the impositions of regulations from the EPA, the Environmental Protection Administration here. It is possible, again, I'm not trying to make a judgment, I'm just saying it is possible, and we'll find out. Much as looking at the equity levels and the credit levels and saying, these markets think that the election of Donald Trump is going to provide economic growth. It doesn't matter what you think, it matters that the facts in front of you, and you must accept the fact that the market is a method of discounting future economic activity. That's its purpose. And therefore, it has already made its judgment. So, from an economy in late 2006, what year are we in? 16. In late 2015, that really did not seem capable of withstanding a Fed program of rate increases. We have an economy which is brushing it right off, or at least we have markets so far that is completely brushing it right off. There is, of course, something behind that. So that's the first issue. The second one is that the zero rate policy being followed around the world if zero rates are so necessary to economic growth, then why are the markets discounting, excuse me, why are the markets discounting future growth at a much higher rate than we're seeing right now by rising, by the credit markets falling, the yields going up? If zero rates have been supporting the economy. The logical conclusion, at least one of the logical conclusions. Remember, there's this old theory, axiom called Occam's razor. What it means, whenever you have a situation or a question that you're trying to answer, provide a theory for, a hypothesis for what's going on, the simpler is better. And that's the principle I'm trying to apply here. If the prospect of higher rates is not dissuading the market used as the measure of future economic activity, then a further conclusion is possible. Is, aside from the potential, effects of politics on the new administration, is it quite possible that the verse was true? That the prospect of higher rates is actually encouraging to economic decision makers. And I would make a case that that's definitely the case. And so that leads us to my main theme, certainly for the second half of 2017. Central banks around the world, even the Europeans, cannot but fail to take note of this. No central bank that I'm aware of is going to come out and say zero rate policies were a mistake, at least for the past 3 or 4 years. They have actually inhibited economic growth. I think they have. Nobody's going to come out and say that. They're going to come out and say what the Fed has said, well, the economy's stronger thanks to our policies, but we're going to raise rates now. Okay. We raise rates because we're afraid of a recession. Okay. But I think in private, and certainly in an analysis, the analysis is being done. And somebody somewhere is writing a paper on this. And somebody's going to make their reputation in economics on this. I am not an economist by training or by bent. I'm a trader by training and an explainer by bent. But I think a good case can be made, both statistically and academically, that a prolonged period of low interest rates, artificially induced interest rates, is inhibitory for an economy and not supportive. We're certainly seeing right now that the prospect of higher rates is not dissuading the US equity markets one bit. Does anyone think that the Bank of England, that the ECB and the Bank of Japan are not considering this? The last meeting from the ECB I thought was very peculiar. I assume it reflected a divided opinion on the ECB board, the governing board. They reduced the amount of support they were providing each month, but they lengthened the number of months that they might continue, at least. Of course, Mr. Draghi has said it will continue as long as it's necessary. Is this, and I don't think this really got enough coverage, an example, a symbol, a sign that the ECB is starting to recognize that zero rate policies do not work. They do not promote economic growth. They can have one ability. They can prevent disaster, apparently, or at least mitigate disaster, but they cannot produce economic growth. And in fact, if prolonged, they inhibit economic growth. Because if they're good, then why stop them? And of course, the logic behind them is, the logic against them is, if zero rate policies are good for the economy, then why don't we just have zero rate policies and everything will be hunky-dory forever? Because that's an absurdity. There's even been some hints from the BOJ that this is being considered there. I mean, if there is any, or was any requirement to acknowledge reality, then anyone would have gone to the BOJ and said, look, we can look at Japan for 20 years, this doesn't work. So I think the theme that we're going to see here, or as I put it in my write-up, are traders missing the obvious conclusion, and I do think it is fairly obvious, that with US rates headed higher, European rates have nowhere to go but up. There is no longer a rationale for zero rates in Europe. Now, let me take that back. There is one rationale, but it's not economic. It's political. We, of course, just had the Brexit vote. We had the Italian vote. We have an election, I believe, in the Netherlands, in France, and in Germany, and very likely an election in Italy this year. The political trends in Europe are not running pro-Euro, pro-EMU, and they are not running pro-EU. So it is more than likely that the stress on the EU and the EMU will continue. In fact, it will probably get more intense. That will, I think, be the rationale, or at least will be a very strong weight in favor of continuing the zero rate policies and the quantitative easing policies of the ECB. But I think the likelihood that both Japan and the Europeans will have seen the error of their ways, especially if the US economy performs well after January 20th and it's the first half of the year and the Fed raises rates again. After all, what does a higher rate of return do to an economy? It draws in capital. And what is that capital used for? Well, some of it just goes into investment, but a lot of it, especially in an economy that has a sense of confidence returning, goes into create jobs, factories, economic growth. So where is European capital going to go in the second quarter and the third quarter next year when it's looking for profitable efforts? It's going to come to the United States. And how will the European economy generate growth and jobs and income if its capital is going somewhere else? So the idea is, how do you support growth with zero rates if your capital is going somewhere else for profitable investment? So the idea that the ECB can continue zero rate policy while the Fed is raising rates, I think, is a fallacy. Yes, the euro will go below parity. So what? So one theme, I think, for this year is going to be this reversal of attitude and policy in the second half of the year. I think this is going to take some time to get going. And I think both the economy and bankers and others and central bankers and planners will want to see whether the US economy really is going to improve and whether or not the Fed is going to continue to raise rates. Okay. Now, the Fed knows a recession is coming sooner or later. I don't know what's going to trigger it, but we're overdue in a business cycle sense for a recession. The Fed does not want to be stuck at 0.75 rates of a new recession. It's just a problem that the Fed now understands is that rates in an economy are not linear in their effect. The effect on economic growth of a reduction or a change in rates from 4% to 3% or 3% to 4% is not the same. And this is where I think economists are going to start producing papers and a Nobel Prize sooner or later on this, that you do not have a linear effect translating from a rate curve, a yield curve, to the economy. That the effect, I don't know, below 1.5% or whatever it is, I don't know exactly what it is, but I would say probably 1.5 or lower on an economy is not the same. If you get a boost in economic growth and economic activity by reducing from 4 to 3%, you do not get the same boost reducing from 2 to 1% or going negative. Economies are not linear equations. They're made up of individual decision makers for whom zero rates apparently are a warning sign. Anyway, so one theme I think is going to be that change in attitude for the world central banks. So what does that mean? I think into the second half of the year, and maybe a little sooner, you're going to get a switch from a stronger dollar to stronger currencies. As imagine if the ECB came out and said, you know, we're going to start ending our bond purchases. The euro would fly up. So that's what's necessary. Remember, we're now in an economic world, in a financial world, in a currency world, where the assumption that everybody's operating under is zero rates in Europe, no change, maybe a little lower, and rising US interest rates. Well, of course, that's going to drive the dollar higher, period. You don't need any more than that to explain the surge in the dollar. Well, if that changes, if the ECB suddenly says we're dropping our next meeting, we're dropping our bond purchase to 40, and we're going to phase them out, you get a reversal of that because the assumption would have changed. The U.S. will still be raising rates, but the new factor would be a ECB that's more inclined to tighten. So I think as we get to the second part of the year, you're going to see the switch in currencies as the central bank policies change. Not so much U.S., but around the world. Commodities are another macro trend that I think we're probably still have a number of years before there's any strong return to a development, if you will, a demand-driven price structure. That's what we saw in the long run until the commodities topped out about 2 years ago. That the assumption was demand, primarily China, would continue rising, and this would power, and did power, much higher commodity prices. Well, as the old cliche is, the cure for high prices is high prices. What we saw in many commodities, certainly in oil, which is the primary industrial commodity for industrial countries and non-industrial, that a totally unforeseen, and this has happened time and time again. I was having a discussion last night with some friends we had over, and one of my guests was claiming that he's very much a Malthusian. That comes from Malthus, the 18th century, I don't know what you'd call him, I guess, a theoretician on population and human societies. And he said, and his idea was that there will never be, that at a certain point, there's never going to be enough food. And so there's a limit on how large a population can grow because there's simply not enough food to feed it. The item that is not factored into that theory, and he was kind of pre-technological revolutions, so you can understand why, was that the other side, the supply side, does not remain static. If the demand side changes, so does the supply side. A fact which seems to have escaped so many analysts, it boggles the mind. We've seen it in food, and we've seen it in commodities. Oil is the best example. We know the story here. 5 years ago, nobody was talking about fracking. And certainly there's going to be a change in energy policy in the United States from the new administration. And there's going to be a cap. I don't care how much the Saudis and OPEC and the other 11 non-OPEC members who were agreed to this this production curtailment or cut prop. It doesn't matter how much they cut if U.S. and Canadian and other fracking and other oil development techniques can replace it. It doesn't matter at all. So I think that this is true in a number of other commodities as well. So the supply side, I think we're switching for the next couple of years from the demand side story, which drove the commodity boom, to a supply side story, which is going to keep commodity prices from flailing higher, especially because one of the, not the only, but one of the incentives behind prices being driven higher so much in commodities was the rate structure around the world and chasing yield. So that's there as well. So I think for commodities, we're not going to see a booming recovery. Demand has to catch up to the increase in supply. I'm sure there's some limit to U.S. and Canadian fracking. I'm not an oil analyst, so I can't give you figures on how much the cost of extracting oil from shale and tar sands in Canada has come off, but it has come off considerably. One thing that you will watch, and it has already begun to change, are the number of drilling rigs that are operating, a Baker Hughes number in the United States, and I think they do Canada too, but I'm not sure. That will tell you what is going on in that energy space. And as the price, if the price stabilizes here, let's take a look at WTI for a second. Okay, that's WTI. So, you know, except for that boom back in when we made it up to 60, it's been 50, it's back down to 51 when I made this chart, which is only a little while ago. So my guess is that looking at this chart for 15 and 16, after the great fall in 2014, that we have and I wanted to overlay the US oil production on it, but I couldn't find the chart in time and I didn't want to be too late for this. I do apologize for that. But my guess is that for 2017 at least, and probably beyond that, there's going to be a natural cap to oil somewhere between 55 and 60. Promoted primarily by the ability of US energy companies and frackers. I think it's rather funny that the Secretary of State, one must never say that Donald Trump does not have a sense of humor, that the Secretary of State is at least the nominee, is the current head of ExxonMobil, I believe the world's biggest oil company. That should be hysterical, if you'll pardon my irreverent way of casting it, when he goes to the next IPCC or whatever the climate change meetings they have, and who shows up but the head of ExxonMobil. That's rather droll, as they might say in the UK. Okay, one more topic we're going to deal with. What are we going to see for inflation? Another macro trend. So I think for the interest rate trend, we're going to see actually central banks reversing their policy on zero rates because it's detrimental to growth, and they're going to realize it. When it comes to commodities, I think we're going to see a cap on commodities simply because they've been overdeveloped. The answer to higher prices, higher prices. Inflation, another macro topic. The Fed's long-running desire to return, if you've listened to my webinars before or read what I've written over the years, I always find it fascinating that the Fed views inflation as a positive. I've never understood this. It seems to me that the only use for a steady rate of inflation at 2% is to devalue economic growth. There's no theory, or there's no proof, econometric or otherwise, that economies need a 2% inflation rate to more effectively promote economic growth. So the Fed's obsession, maybe too strong a word, with producing 2% economic growth, 2% inflation, seems to be misplaced from a theoretical point of view. Aside from that, are we going to get it? Well, you know, inflation depends on how you measure it. And it doesn't seem to me that well, let's put it this way. The Fed is raising rates, and they're determined to raise rates if they can get away with it, whether or not inflation is rising. There's certainly no indication of wage inflation right now. If you look at the historicals, we're nowhere near here in the United States what was historical level in wage growth. For whatever the reason is, I'm not going to argue. They're not going to discuss what the reason is, but we're not there. So the Fed is not determining its rate policy based on inflation. They may say they are, but they're not, because it's not happening, and they're raising rates anyway. So based on that, and based on the oversupply of many commodities, the pressures on wages, and it's not only from competition overseas, it's also from automation, that a return, despite all of this, another thing we've seen is inflation is always and everywhere a monetary phenomenon. Well, maybe once you get inflation, that's true, but certainly it is not true that a monetary phenomenon is enough to create inflation. That was the Fed's theory going into this, and it has not been true. There's a very strong demand factor in inflation. If you don't have the demand factor, you don't get inflation. So the last macro topic that I'll talk about, or that I'm going to give you a conclusion on right now, is inflation. And I do not think that we're going to get a return to rising inflation rates. Commodity prices don't predict it, neither does supply. Wage does not predict it either here in the United States or overseas. Global competition and the ability to source and manufacture globally does not lead, excuse me, to a sense of higher inflation. So those are our macro themes, and we're going to end now because we've been out here about an hour, for what I think we're going to be looking at in 2017. For the first half of the year, I think we'll still have a stronger dollar. After that, watch out if central banks start talking about reversing policy, and they're not going to do it overtly, but the signs will be there. Inflation, interest rates are going to start going up around the world. I don't believe that the ECB will want to stand the drain for its economy, for productive capital investment, from too great a disparity in interest rates. Commodity prices are going to stay relatively low and stable, I think, for reasons that I've said, and inflation the same way. Okay, everybody, thank you very much for attending. I hope this was useful. I will be elaborating on some of these themes over the next 2 weeks on the inevitable write-ups and what's going to happen in the new year. I hope this was interesting and instructive. I hope it was a little bit entertaining. And I wish you all a very good day, and we'll see you next week. Take care.